So by the end of this video, you will learn why real estate is a necessity, and also why real estate is closely related to the credit market. And also, you will have to watch until the very end to find out. And just to start with, a lot of people knows that real estate is a necessity because you need a roof over your head, place to stay in. But what a lot of people don't know, real estate is not just a consumer product, it can also be an investment. And these investment holds value and appreciate in the long run. For example, if your girlfriend asks you to buy a Hermes bag for her and you treat it as a consumer product, she might be very angry. Why? Because Hermes bag is hard to get and it tends to appreciate in value as well. So the value of these investments are not determined by the benefit that brings to the consumer. It's actually determined by the value the future buyer is willing to pay for it. Therefore, a lot of these investments, as it goes up in price, people see the appreciation, they want to put more money into these investments, and that snowball just kept going. Now, if we come back to real estate, a lot of time a house or a piece of real estate is a person's net worth. It might be your net worth, and you're not the only one. In China, 70% of the family's net worth is in real estate. Back to the United States, it's 29%. That's still a very high because 1/3 of everyone's net worth is also in real estate. Now, if we look at from the net worth to ownership of real estate perspective, the higher net worth people has a smaller amount of their portfolio in real estate. Whereas if it's a middle class family or lower net worth people, they actually have a lot more of their investment in real estate. Now that you understand real estate is necessity and also is closely related with investment, the next thing I want to talk about is how closely related real estate is with the credit market. If you're not familiar with credit, most people buy their houses by borrowing money from the bank. When people borrow money from the bank to buy real estate, it's called a mortgage. And mortgage is a form of credit. Since real estate is a necessity for most people, many people are willing to create a credit that will last 10 years all the way up to 40 years long. So why does real estate in the most wealthy country has been appreciating in the last 50 years? It's because they were increasing at a speed that's much faster than the income increase. In the past 50 years, real estate price in the most wealthy country has been going up. So you're probably wondering why, what's propelling all these price increase? And the answer is credit expansion. If we look at the real estate mortgage to a country's GDP, comparing them back in the 1950s and comparing them again over 2000, back in 1950s, only 15% of the GDP is from real estate. Fast forwarding to 2011, 70% of our GDP is relying on real estate. Since we know that the real estate and the credit loans are closely tied together through our banking system, and also we know that most people have real estate as their asset. Therefore, through real estate and the banking system, most people's wealth are linked together. When you buy real estate, you're using the piece of land and the property on top as a collateral to borrow money from the bank. Under normal circumstances, if real estate price continue to go up and you fail to make your mortgage payment, the bank might come and take over your house and sell it on the market. And because the market has been continuing to go up, they're more than likely to break even or even make some profit. Now, on the other hand, if the housing price plummet and you can or choose not to make your mortgage payment, then that means the bank has to take your house and sell in a plummet market, and it's very likely for them to lose money. And this is when a lot of the mortgage loan will be defaulted, and this is when bank will decide to tighten up their lending policy. The assets to liquidity and credit will be reduced. Economical activity will decrease. A lot of companies will run into financial problems or even go bankrupt. Total demand for consumer spending will go down and eventually will run into a recession. So in basic terms, if real estate price crash, the credit market will crash as well. If the credit market crash, banking system will crash as well. So in basic terms, a real estate price crash, the credit market will crash. If the credit market crash, the whole banking system will crash. If the banking system fail again, then people will run into trouble just like what we have witnessed in 2008. So similar to what I just mentioned, increasing interest rates is actually very similar to tightening the lending policy. But why is it going to slow down the economical activities in the market? Because this might lead to a credit crunch. Most real estate crashes are derived from credit bubbles. As I mentioned just now, most of the chain effect started from real estate price crash and more people breaking your mortgage contract. And through credit crunch, it gradually moved into an actual recession. These two bubbles are enough to move a nation's economy into recession. According to the IMF's research, out of the 23 countries that have both of these bubbles, 21 of them went into a deep recession. Out of the last 50 economical crises, 35 of them were derived from a real estate price bubble. Some of the widely known ones are Japan's in the late 1980s, and also the subprime rate in US in 2018, and also the Europe debt crisis after 2010. So why is it really tough to save a banking system after a real estate price crash? Because not all countries are like US or Japan. If they run into a credit crisis, they can just print more of their own money to balance out the monetary policy. Countries like Ireland and Spain, which are part of the European Union, they can only print money if the European Union allow them to, unless the European Union start printing money for all the countries in the European Union. So now that we know real estate is a necessity, we know that real estate could be investment, and also real estate is closely related to the credit market, we're going to get into how does real estate has such a big wealth effect on your life. When the real estate price goes up, the wealth effect is very subtle. But if the real estate price goes down, the wealth effect is very noticeable. Now, if you ask why is the wealth effect asymmetric between the price going up and going down, that's because of the psychology of us. So let's explore this a bit. So most people out there, unless you're an investor, you probably only own one house. So if the price goes up, you're probably not gonna sell your house next year just to profit the difference because you need to start renting. So you're probably just gonna feel a little joy, the house price goes up, but it's not gonna change your spending habit. And there's another group of people who are just starting out and still trying to save their first down payment to buy their first house. As the house price goes up, it's harder for these people to save up and keep up with saving for their down payment. So it's very likely for them to cut back on your spending, maybe eat more instant noodles so they can save money faster. And also, just a side note, in the Asian culture, having a house, owning a car is almost like a wealth symbol to show that you're financially capable enough to form a family and have kids. Therefore, even when the house price goes up, even the consumer spending for those people who are still trying to save up for their down payment can also go down. So the subtle increase in consumer spending when the real estate price goes up is really offset by a lot of people who are saving for their down payments, and just the subtle joy of people who are still keeping their house or not willing to sell it because they need to start renting. Now, like I mentioned, if the real estate price goes down, the negative wealth effect is very noticeable. Let's say if you buy a $2 million house this year, and next year, the house price goes down to $1 million, but you still have a mortgage of $1.5 million. I bet you'll probably be eating out less and buy less toys just because you're actually owing more money to the bank than what your house is worth. And in turn, your consumer spending decreased. So during the dot-com bubble in 2000, $6.2 trillion evaporated from the stock market. But for the next 2 years, the consumer spending did not decrease, but actually still grow at a single digit. Compared to 2008, where $6.7 trillion was again evaporated in the stock market, and $30 trillion was evaporated from the real estate market. This time around, there's more than 10% decrease in the consumer spending for the next few years. And that has been the biggest drop in consumer spending, only second to the beginning of pandemic in 2020. This is why real estate market plays such an important role in our economy. So now that you learn why real estate is a necessity, how it could be an investment, and how a real estate bubble burst can cause both the credit and the banking system to fail and in return cause a recession in our economy. If you want to learn more about how stock market can also affect our economy, make sure you subscribe to this channel, hit that like button for this video, and I would like to know your thoughts on whether you think we're already in a recession, we're heading into a recession, we're actually still in an expansion. Okay, drop that comment below and let me know when we'll chat about it.